Welcome to DNB and this webcast where we'll discuss the outlook for the dry bulk market and the 2020 bulkers. I'm joined by Magnus Halvorsen, the CEO of the company. Happy to have you here, Magnus, and DNB's shipping analyst, Nicolay Dyvik. And we'll touch upon 2020 bulkers during the session, but let's start off with the market, because you ordered 8 Newcastlemax dry bulk vessels, which are being delivered as we speak in a rate environment which are at a 10-year high. What do you think is the main drivers behind the spike we have seen in the Capesize rates year to date?
Well, I think it's been an interesting year to say the least, and you mentioned the spike, but I think it's worth looking back a bit into the first half of the year. I think we started the year around 15,000 a day, and then quite early on the market was actually hit by 3 accidents at one time, which I think each individually would have had a severe impact on the market, referring to the dam accident in Brazil in the beginning of January, which took out 93 million tons of production. At the same time, you actually had very severe weather in the northern region of Brazil, which also produces iron ore, and exports out of that area fell more than in the areas affected by the dam accident. And to add to all the troubles, we had a cyclone in Australia, which led to force majeure. And I think from a fairly optimistic start to the year, rates hit the bottom of 3,500, which is not a good market for anyone. And I think what's led to the recovery from that level is both driven by the supply and the demand side. On the volume side, I think we've seen a gradual resumption. Of course, the weather-related issues, they pass, and volumes out of northern Brazil and Western Australia came back. With regards to the volumes that were shut after the accident, 30 were back by this summer, another 30 is being ramped up gradually. On the supply side, I think it's been a year with fairly limited supply growth. We saw lots of scrapping in the beginning of the year. 24 Capesize were scrapped until April, against 12 all last year. And I think as rates recovered, that obviously the scrapping activity subsided somewhat. But I think as well we're starting to see the effects of scrubber retrofitting. So it's being driven by both sides of the supply-demand equation. Volumes coming back and some limitations on effective supply growth.
Yeah, and we'll come back to some of these things later.
If you look at economic indicators, the Chinese PMI has declined 4 months in a row, 49.5 last observation, and it's correlated with the Baltic Dry Index. When we have looked at the impact of the trade war to dry bulk, you could talk about soybeans and so forth. But if you look at activity levels in China, there's a 80% correlation with dry bulk rates. PMI has gone down, dry bulk rates gone nothing but up. Which one has to give? Is it sustainable, the current strength we see?
Well, I wish it was as simple as just looking at one indicator and you would have the answer for the whole dry bulk market.
It's a tough question, Nicolay.
But I think if you look at what China, it's clear that the economic growth in China has been slowing, and of course you have the trade war, which is giving more global uncertainties. I think China's response, particularly since the summer, has been to stimulate infrastructure investments, which they've done through sanctioning new infrastructure projects, but also loosening up on credit, stimulating the issuance of local infrastructure bonds. So it seems like, in a way, as they did in 2008, when there were times of global economic uncertainty, China is counter-reacting by stimulating infrastructure spending. And I think that's really what's driving it, and we'll see if something has to give in the end. But for now, I think looking at the key indicators for the large dry bulk vessels, steel production, it's running at high levels. They're not really building inventories, which suggests that steel production is finding a home. So I think we are fairly optimistic, I guess more optimistic than your PMI with regards to the demand side.
So if you look at iron ore, Brazilian iron ore volumes have clearly recovered, but there's still a few million tons below last year. Australian volumes are down year to date, but on last observation they're par with last year. Chinese iron ore imports are down about 5% on a year-over-year basis. What should the market expect in terms of iron ore volumes into the second half of the year and next year?
I think we should expect a continued ramp-up, which is very much in line with what Vale has most recently guided. If we start by talking about the 93 million tons that were lost, as I said, 30 is already back as of, I think, July when they made their last statement. They say another 30 is coming back on by the end of the year. But on top of that, you have to remember we have certain projects that are ramping up that weren't affected. S11D, the world's largest iron ore mine, is still ramping up, Minas Rias. So I think when we do the numbers, really just aggregating the individual project guidance bottom up, we assume end 2020 we will have a Brazilian output which is approximately 30 million tons higher than what we had end of 2018. Of course, I think January showed that we can have accidents, and that will of course change things overnight if anything like that happens. But if things go according to plan, I think we will see a gradual volume ramp up for the second half of the year and also into 2020.
Magnus, China coal made up 70% of China electricity consumption in 2018, and 2019 China coal imports year to date is at up 7.5%. How do you see coal playing out in Q4 and 2020?
I think there's no doubt that coal, as a share of both the global and Chinese energy mix, is going to get a smaller share, and it's being displaced by cleaner alternatives, renewables and natural gas. That being said, I think coal will still be a growing commodity. I think if you look at the latest government data from China, there's an expected 12% growth in coal-fired power capacity from 2018 to 2021. And I think if you look at it more globally, I think there are projects sanctioned today which equal around 20% of the current installed base. So I think coal will continue to grow. You asked about Q4. I think the risk we have in Q4 is China last year imposed import restrictions towards the end of the year. And what had been a fairly firm market from a volume perspective overnight in November last year went to zero imports because China had put in quotas. And you know, that could happen again this year. But I think overall you will continue to see some growth in coal, both for China and also for other Southeast Asian economies. But it's probably one of the parts of the dry bulk market that's harder to predict because China consumes around 4 billion tons and they import around 300 million. So any change to their domestic production can have a fairly large swing on imports and seaborne volumes.
If you won't keep on saying that coal eventually will decline market share, but if you look at Chinese coal imports, you know, as you said, they've been close to double digit now for years. And coal inventories in China are brought down to 2005 levels, declined 4 consecutive years. And coal production in China was quite slow in Q1, but has ramped up quite sharply recent months. Is that the threat to the import story you see?
Well, I mean, if Chinese coal production gets too high, it's clearly going to be a headwind for the shipping markets. But I think if you look at this year, there was a fairly large ramp up in domestic coal production until May. But I think if you look at the June and July figures, it's actually come back down a bit. And I think if you look longer term, China seems to be focused on closing domestic production capacity, which is more polluting, and also the mines that are less safe and where there has been accidents. So I think over time, just given how little China imports compared to what they actually consume, there's probably more upside than downside, but it will certainly be volatile. I mean, Chinese policy around coal imports has been very volatile, and it's been known to change several times within a year. So to some extent, it's a bit unpredictable.
Yeah.
Around 35% of all Capesize vessels have order scrubbers. Retrofit installation started in Q1 with below 10 installations per month, but since then it has accelerated. How much of the rate upswing could be explained by the retrofits?
I think it's definitely had an impact in addition to the recovering volumes. We spent quite a lot of time trying to look at the numbers, and you end up getting slightly different answers. But I think the way we've tried to summarize it is around 60 Capesize had scrubbers being fitted in the first half, and we see around 140 for the second half, with that number being fairly back-end loaded. And we see around 100 confirmed for next year, with another 170 which are likely candidates if you look at the age profile, etc. of those ships. So I think it's had an effect, but I think that effect is going to intensify towards the end of the year, and I think it will still be in place in 2020. And we are increasingly hearing about problems with some of these scrubber retrofits. I think both related to the time it actually takes. I think when people were planning these, I think the average answer you would get was probably this will take 20 to 30 days. There's certainly been cases where we know it's taken a lot longer, 40, 50, even 60 days. Of course, there's a learning curve, and I think those numbers will come down. I think secondly, we are seeing there are capacity constraints at Chinese shipyards. It seems that some of them are simply overbooked, and that's creating some issues in the supply chain. So we'll see. It's had an effect. I'm not going to quantify it with regards to a dollar per day number, but I think more importantly, that effect will be there for some time, and I think it will intensify as we move towards the later part of the year.
Yeah, it's interesting to hear your take on it. Yeah.
In our research, we've taken away 1.7% of the dry bulk balance in IMO supply disruptions, and then we've taken a day count on off-hire.
Yeah.
But what I think we've underestimated is if you start to run delays. Those that are most prepared have installed early. Those that are least prepared are the latest to install, and now you start to see more delays since this started really, as you said, in June. And if you have booked a time slot and there are 3 weeks, 2 weeks delays, you still have to sail to that shipyard and then wait for your time slot. Since if you start the voyage, you might be too late and not come back. So it's that additional off-hire in waiting time for your time slot. One thing is the time it takes to retrofit, but I think that's probably a bit underestimated, at least by us.
No, I think you're right, and I think we're hearing more and more examples, and I think we also heard of some owners who have booked their slots, and then the yards will get a higher bid simply for the conversion, and they will just push them aside.
Yeah.
So they seem to be a bit flexible in that sense.
One topic which is, of course, a lot debated in terms of CO2 emissions, how to solve that in shipping, has also been through speed. Many have taken the argument that speed next year would go down since fuel price will go up, but there is also a share of the fleet installing scrubbers, which is about a third of the Capesize fleet will have scrubbers fitted on their ships, and they are incentivized to sail faster than the non-scrubber fitted ships. Today we calculate that the sailing speed is about 11 knots, and post the dam incident in Brazil, we saw that speed went from 11 to 10.3 knots on Capesize, and that's equivalent to a 4% utilization improvement. So the speed quickly declined to take up for the Brazil effect, which we calculate was about 2% on utilization. But now speed is 11. But if you look at the speed curves, then given the current rates and the bunker prices, speed should go to 13 if you look at compliant fuel, but close to full speed if you look at the 3.5% sulfur fuel. Yeah. How do you see this pan out from today? One thing is 2020 over yearly 19, but from where you stand today in terms of the duration of the current high rates?
Yeah. No, I think when we run voyage calculations and apply that to the fleet, I think, of course, as you say, the non-scrubber fitted ships will in theory slow down. And we think that could have an impact just based on the forward curve of around 4%. And I think you have to then also add the fact that scrubber fitted ships will speed up. That will have a lesser effect. And I think we calculate the net effect from just the changing fuel prices to be around 3.5%. I think that effect is probably, we may already be seeing some of it. Because if you think about the nature of the Capesize trades, if you do a round voyage to Brazil, that's 90 days, and you're not allowed to bunker on the way back. So probably have to add another 10 to that. If you leave China today and you want to enter into January with compliant fuel, you have to calculate 100 days margin. So I think we are probably starting to see some switching fuel already. And I think also if you look at the fuel spreads, I mean the spread between low sulfur and HFO has for the last 18 months largely traded almost one-to-one correlated with Brent, but a few weeks back I think we saw those decoupling. So I think we're starting to see those physical adjustments taking place and some people already switching, which could explain some of why speeds haven't gone up more in spite of rates being as strong. I think longer term, we'll see there are some fairly strong forces trying to lobby for, I guess, speed limits, if you will, which is of course one of the easiest way you can reduce CO2 emissions without any significant capex. And there was a petition sent to the IMO a few months ago, which was signed by around 120 shipping companies. I think a lot of very major and significant companies, owners from all over the world. Whether that will have an effect or not, we'll see. But there are, it's certainly on the agenda, and I think if it happened, it would clearly be positive for all of shipping rate-wise.
Yeah.
But I wouldn't bet on it.
Okay.
It's been very interesting to get your take on what's happening in the market, Magnus. But in terms of 2020 bulkers, how does the company differ from other dry bulk companies?
Is it possible to differ in a commoditized world?
Well, it's difficult, but I think, of course, if you are investing in commodity shipping, there's a few criteria which I think will dictate your success, and one is obviously timing. And this company was established, after 7-8 years of weak markets, with ships ordered at essentially a close to 20-year low with regards to newbuild prices. So if you have a low cost on your investment, that's obviously going to make it more likely that you can make a good return. The second thing, which I think does differentiate us a lot from other public companies with large dry bulk vessels, is what exact vessels do you have? Our ships, we've been talking about the Capesize market today. We have Newcastlemax vessels, which are slightly larger. They can take around 15% more cargo. And we see that we are being paid a significant premium for that cargo intake. A few years ago, they may not have been the preferred vessel because they were not as flexible in trading. But I think today, if Cape rates are 35,000 a day, we are making close to 50,000 a day. And that's before any of the scrubber benefit takes effect. And I think the last thing is we've tried to set this company up with a very low cash break even, coming from two things: low G&A and also a reasonable amount of debt at a reasonable price. And I think combining those two, an earnings premium and a low cash break even, we have a fairly unique structure risk reward wise. I think today, clearly, if we're earning between 45 and 50 on a vessel in the spot market, and we have a cash break even of 14,000, there's a lot of potential dividend capacity.
Can you talk about monthly dividends?
Yes, we have said that we will be the first shipping company to instate monthly dividends as we get closer to delivery of the full fleet. And I think that also has a lot to do with what I think is one of the key criteria. One thing is to buy cheaply and to buy the right assets. But I think discipline in not chasing the cycle is very important. And we intend to return everything we earn above cash break even as dividends to our shareholders. As opposed to, I think, many other public companies which seem to have a strong focus on growing their fleets. And I think if you are looking to grow at all costs, you typically will buy ships when capital is available. That's typically when asset values are moving higher and when rates are strong. We are very focused on harvesting the investment that we made at the low point in the cycle and returning that capital to the shareholders as quickly as possible.
When we talk about harvest, could that be asset sale, or is that not part of the agenda? The part of the agenda is to reap the benefits from dividends.
No, I think we have set the company up such that we are likely to make a good return taking dividends. That being said, we are very pragmatic. We are investors in the shipping sector. In this case, first and foremost, we're not looking to build a shipping company for the sake of building and running a shipping company. So any day we get the bid for assets or the company, we would seriously consider that. And we would not see it as a defeat to sell the whole company, whether it happens in the next few months or the next few years. But it's not a necessity. I think we have set the company up with a structure. If you go back to April, it was a very uncomfortable time to have 8 ships on order. I think the only good thing we got out of it is we wanted to take a bit of cover in case it took longer for the market to come back. So at the time when spot rates were 3,500 and 1-year Capesize rates were around 13,000, we were able to fix a 1-year charter. Actually did 2, so the average on those were 21,000 with a very strong counterpart. I think that kind of stress test, which we certainly didn't ask for, but it showed that even in a fairly disastrous scenario where the market collapses, we were able to fix out ships at the level well above our cash break even. So it's nice to have upside when the market's good, but I think it's even more important for your longevity to have a cash break even which keeps you alive when unexpected things happen, because they will happen again in shipping.
In terms of timing of the dividend, are we talking start in early 2020 or late 2020, or does it remain to be seen?
Well, we have recently listed, and what we said in our prospectus is we will pay a dividend when the full fleet is delivered. But I think we said subsequently in the second quarter report that we will target dividends in Q1. I think that has to do with the market having been stronger than we expected. So I think our target now is to announce the first monthly dividend at some point in Q1.
All right, that sums it up. Thank you again so much for joining us, and thank you for watching.
Thank you.